The 1980s were a time of incredible prosperity for Japan. The nation was experiencing an economic boom, a period often referred to as the Japanese economic miracle. After the devastation of World War II, Japan had rebuilt its economy into a global powerhouse. Japanese companies were at the forefront of technology and innovation. Products like Sony Walkmans and Toyota cars were in high demand worldwide. The streets of Tokyo were bustling with energy and optimism. The success of Japanese companies translated into a surge in stock prices. Real estate values in major cities like Tokyo and Osaka began to skyrocket. Land prices were increasing at an astonishing rate. Japan seemed unstoppable, its economy a shining example of success on the world stage. There was a sense of national pride and confidence in the air. The future looked incredibly bright for Japan and its people. However, beneath the surface of this economic boom, warning signs were starting to emerge. One significant factor contributing to the unsustainable growth was the Bank of Japan's loose monetary policy. Interest rates were kept low, encouraging businesses and individuals to borrow heavily. This influx of easy money fueled speculative investments in the stock market and real estate. People were buying assets not based on their intrinsic value, but on the expectation of selling them later at a much higher price. As more money poured into these markets, prices continued to inflate, creating an asset bubble. The stock market reached dizzying heights and real estate prices became detached from reality. A sense of euphoria and invincibility took hold. People were eager to get in on the action, often taking on significant debt to purchase assets they believed would make them rich. Few questioned the sustainability of this rapid growth or considered the potential consequences of a market correction. The party couldn't last forever. In 1989, the Bank of Japan, concerned about rising inflation, started to raise interest rates. This move pricked the bubble and the markets began to react negatively. As interest rates rose, borrowing became more expensive and the flow of easy money into the stock market and real estate slowed down. Investors, sensing a shift in the market sentiment, started selling their assets to cash in on the inflated prices. This selling pressure led to a sharp decline in asset prices. The stock market crashed, wiping out trillions of yen in value. Real estate prices plummeted, leaving many investors with properties worth far less than their mortgages. Banks were saddled with bad loans as borrowers defaulted on their debts. The Japanese economy was in freefall. The once thriving economic powerhouse was now facing its most significant challenge since the end of World War II. The collapse of the Japanese asset bubble had a devastating impact on the country's economy and society. The 1990s, often referred to as Japan's lost decade, were marked by economic stagnation, deflation, and a rise in unemployment. Businesses collapsed, banks struggled to survive, and individuals faced financial ruin. The once confident nation was grappling with the consequences of its economic missteps. The Japanese asset bubble serves as a cautionary tale about the dangers of unsustainable economic growth, speculative bubbles, and the importance of sound economic policies. It highlights the need for a balanced approach to economic management, where growth is sustainable and inclusive. While the road to recovery was long and arduous, Japan, with its resilience and determination, has been able to rebuild its economy and regain its footing on the global stage. The lessons learned from the bubble continue to shape Japan's economic policies today, serving as a reminder of the importance of stability, sustainability, and the need to avoid the excesses that led to the bubble in the first place.